Hello, this is Xavier Clark, local mortgage lender here in Augusta, Georgia. Today we're going to talk about what influences mortgage rates or interest rates. I do mortgages, but we're also going to kind of briefly touch on maybe other rates as well, but this is mostly going to be about mortgages. Some people want to know this, they ask me, or they kind of throw their thoughts. So I want to make something as short as possible. I don't like making too long of videos, but also as complete as possible, as simple as possible, but also as complete as possible. So we're going to touch on a few important things, but hopefully by the end of it, you can know, hey, if you want to know what influences interest rates and what creates the rate that you have, this video will teach it to you. So in a nutshell, we can summarize it by a few things that impact your rate. You've got the health and state of the economy. And by this, I usually mean the U.S. economy, but also the world economy if you want to. And these are two separate things, actually. So the health of the economy is usually sort of measured by different metrics. You might have the jobs report, which talks about unemployment, or maybe the CPI, which is going to talk about inflation. Inflation meaning the prices of goods, or the increase in price of goods as related to some sort of benchmark number, which in turn, you could look at the strength of the dollar. There's many different things that indicate the strength and health of an economy, the U.S. economy. But that will play into it, as well as the state of the economy, which is a lot more, it's kind of a more vague, more subjective kind of idea. But basically, is there stability? Do people feel good about the economy? That kind of thing. If there's all sorts of unrest or something, then that might disrupt sort of the economy and thus the market, and could potentially affect your interest rate. Now, the important thing to know about this is that these things sort of indirectly influence a rate. They influence it to the degree that people who have the control over rates look at them to kind of make their decisions, including the U.S. Reserve, which we'll get to in a second. So the next thing is investor demand in the secondary market. We're going to talk about the secondary market in a lot more depth in a second, but essentially investors, whether they be a hedge fund or if they're a huge pension fund, they may be some sort of sovereign nation or, a foreign fund. It could be many things. But when we say investor demand in the secondary market, we're not talking about, hey, I've got $20 to invest. We're talking about billions and billions of dollars, potentially trillions, just depending on what instrument you're referring to. But the secondary market is massive. So investor demand and appetite in that market. And then lastly, the U.S. monetary policy is going to play a tremendous role in an interest rate. So we're going to get to a little bit more depth. Again, we're going to try and keep it as simple as possible, but as in-depth as possible, at least as complete. So you got your rate, right? And it's just a number. Whatever you think in your head pops in, you get that number and you say, okay, that's good, that's bad, I like it, I hate it, I want some more of it, whatever you think. But you got your rate. Okay, and you say, well, what goes into that rate? Well, the very, very, very first thing that's going to sort of be right above that is the borrower profile and your loan type, right? So, borrower profile means your income, your credit score, how much you put down on a certain loan, right? But then also the loan type. And by this, I'm talking mostly about mortgages, but also, as most people know, a car loan does not have the same rate as a house loan or a airplane loan or a credit card or, a student loan. They all have different rates because they're different types of loans. But your borrower profile and the loan type is going to really, really directly influence the number that you're getting. But again, for a mortgage, this will also relate to, again, your credit, your down payment, what type of program you're doing, all that. But on a more macro level, you've got the loan marketplace and competition, and also economics and profit. So by loan marketplace, I mean, hey, let's say that there was just one bank in the world. Rates would not be favorable to borrowers most likely because that bank could have a monopoly on all loans and just charge whatever they want. Because essentially an interest rate is the cost of money to you, basically. So they would just charge you whatever they want. So luckily for us, there's many lenders. There's a lot of competition. And so that, affects the rates as well. So no one lender controls that in the free market, so to speak. Now, as far as economics, what we mean by this is just like any sort of situation with the marketplace, you have buyers, you have sellers, right? You have supply, you have demand. All right. So there's not just one supplier, not just one demander. And the marketplace has many participants. And sellers want the highest price, buyers want the lowest. Wherever they meet is considered the market. And so that is going to play into it. But then also the profit. So every company is in business to make a profit. But different companies have different profits that they seek to make on whatever they're doing. So that's going to play into it as well. So that whole complicated little charade is going to impact you and your borrower profile and your loan type, and then lend down to your interest rate. So most people can kind of understand that. So now we're going to get into a little more higher concepts. Hopefully, again, we're going to try and keep it short and sweet, but educational and simple, but also complete. You got the secondary market, and that's what I was referring to a little earlier. This secondary market is massive, bigger than you think, I promise you. And the secondary market is comprised of many participants, all with many dollars, high dollars. And when we were talking about the secondary market, in this specific instance, we're going to be referring to a few specific things. You got the GSEs, mortgage bonds, and correspondent lending. Those might sound like alien terms to you. Maybe you're familiar with them. Maybe you know what they are. But anyways, GSEs. By GSEs, we mean Fannie Mae and Freddie Mac. All right. GSE stands for government-sponsored enterprise or entity. I'm not sure actually which one that stands for, but it's a government-sponsored company. They're technically considered private companies. They're publicly traded, but private. But they're actually backed by the government. They're kind of the hand of the government, if you will. And Fannie Mae, Freddie Mac, they're very similar. They actually are different, but the differences kind of honestly depend on what day it is. They're very similar with some differences. But again, the GSEs are those companies. Now, what do? They basically provide a safety net, if you will, to all mortgage lenders. So now we're talking specifically to mortgages, but they provide a safety net to all mortgage lenders in the country. And what they do is they say, hey, if the loan is made with these rules called guidelines, then if you ever want somebody to come by and buy this loan off you, as long as it fits into this little box, if you will, it's called conforming. But as long as it fits and applies, or these rules are, applied to it, we'll buy it whenever you want. And so that provides a huge safety net to lenders. Okay, so that's what Freddie Mac and Fannie Mae do. Mortgage bonds are when you take a bunch of mortgages, package them together, and then sell them to investors, whether it again is a hedge fund or be it a sovereign wealth fund or whoever, Goldman Sachs or the Harvard pension fund or Harvard endowment. It doesn't really matter, but they'll buy mortgage bonds and they'll collect the proceeds or the income from that bond. So just to give you an example of what it may be 1,000 mortgages, all paying $1,000, right? That's $1 million a month, right? And they might pay, we'll just call it $50 million to make $1 million a month, right? Or maybe 20 million, maybe 30. And that market is always trading, always active. So investor appetite is going to play into that. And we're going to talk about that real quick in a second. And then correspondent lending is basically you have a big bank and they say, hey, we want to buy some mortgages or get in the mortgage game or have this number of mortgages. So they'll have a smaller bank or even a mortgage broker, if you will, do the hard work of creating the loan. And anyone who's gotten a loan knows that there's a lot that goes into it. we let a smaller interest do that, and then we'll buy it from them, pay them a little spread or a little profit on that loan, and then we just collect all the payments from there. And that's what a lot of institutions do, because that allows them to keep lending even though they're small, and generally it lets borrowers get a little bit of a lower rate, a little bit lower fees, and everything keeps moving. Now, anybody who's ever seen The Big Short or something like that kind of knows what mortgage bonds are and how this all works, and it kind of gets a bad reputation, but really this secondary market is where all the money in the mortgage marketplace kind of comes from. And so if it wasn't for this and all the security that it provides, the idea of, hey, I want to put 3% down or 5% down or even 20% down. A lot of people think 20% down is a huge amount of money to put down. But if you think about it, you're still borrowing 80%. The only reason that is even possible is because of this. So the only reason why it's even possible is because of this secondary market. If it wasn't for that, and there was a time that these things did not exist, this marketplace did not exist. There are countries where this does not exist, and you have to buy cash. In previous times, before this was, in the state that it was, if you could have a bank give you a loan, first off, you definitely weren't getting a great rate per se on it, right? But you had to put at least 50, 60, 70% down sometimes, and there was no way you were getting a 30-year term to pay it back. You might get a 1-year term or 2 or 3 or, maybe a 5 or a 6, but, you definitely weren't getting a 30-year term with 1% down or 0% down or 3% or anything like that. And your rate was not going to be favorable. And on top of that, you had to be an extremely strong buyer or borrower, and you had to have a really strong reputation and relationship with that bank. So the idea of, hey, I just want to get a good low-paid down payment and good rate for 30 years, that only exists because of this secondary market. So it's very important. Now, just to kind of wrap this part up, mortgage bonds, to kind of understand how this relates to your rate, you've got to figure that people investing in bonds are looking to get a return. And there's a lot of sophisticated analysis. We're not going to get into all that, but these bonds are competing against things like the stock market or the risk-free rate, which we're going to wrap it up with in the next part. But they're competing against these types of other investments, or even, hey, we could invest in a Hollywood movie or, anything, or just real estate or build a hotel or something like that versus a mortgage bond. They're always balancing the risk and reward. So these mortgage bonds, the appetite for them is going to, again, trickle down to the loan marketplace and your borrower profile to come up with a rate that you pay. Okay, so the last part, the overlord, the granddaddy of it all is, of course, ding, 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 the United States government. All right, so just kind of starting from the back here, but we talk about the U.S. government in relation to, again, mortgage loans, but even potentially other loans such as student loans, right? The government backing a loan has a huge impact on the rate, which is why if you get a VA loan or a USDA loan or FHA loan, these loans have, generally speaking, drastically lower rates than a conventional loan. Conventional loan being a Fannie Mae, Freddie Mac loan, or even a loan marketplace loan, which would be like a portfolio loan directly from the bank. The government's backing the loan, so it's less risk for the lender, so they give you a better rate. Okay, so the government, and again, this is not quasi or, sort of backing it like a GSE, but this is directly backing. The U.S. government does that. The 10-year Treasury is barely going to touch on this, but a lot of people look at the 10-year Treasury and say, hey, that, trends with mortgage rates. And it does because, again, going back to the investment aspect of all this, and again, we're talking about billions of dollars, the 10-year Treasury the Treasury notes of the United States government are considered the most risk-free investment there is. And a lot of people say, oh, well, there's this huge deficit and, so on and so forth. most of those people don't really know exactly what they're talking about per se, at least not in relation to this. Because if the government needs to pay its bills in U.S. dollars, what are they going to do? They're just going to print more money. So there's really, it's considered risk-free for investing in a government treasury, at least in the current environment. And it has been for quite some time. So if you can invest in the whole world of things to invest in, but you can invest in the United States government and not pretty much be guaranteed to get your money back, that is going to be sort of a benchmark, just like the S&P 500 is a benchmark for stocks, so on and so forth. So a lot of people watch the 10-year and they trend together for various reasons. And again, when you're looking at these things as investments, it's not just the risk that people are going to pay back the loan, but it's also the yield. If people pay back early, you won't make as much money. So the 10-year is kind of seen as a good note, because most people don't hold mortgages for 30 years anyways. So again, that's just kind of touching on that. There's a little more to that, but we're not going to go too deep in that. And then the last is the Fed funds rate. And so this is kind of, again, the granddaddy rate. When people talk about, the Federal Reserve, they cut rates or they raise rates, this is the rate they're talking about, the Fed funds rate. And it's essentially, just for a simple definition, it's really the cost of money to banks themselves. So if a bank has to get its money from somewhere, which is usually the United States government, right? And you hear about the FDIC and other things, but basically banks get their money from the government for all intents and purposes. And there's a lot of other things like liquidity that the banks have to have and certain ratios and all that sort of thing. But the Fed funds rate is essentially the rate that banks get their money for, long story short. And more specifically, it's actually the rate that banks charge each other, because the United States Reserve has several banks, and then they lend money to each other, and then they lend that to other banks, so on and so forth. But again, the Fed funds rate, for all intents and purposes, is the rate that banks have to get their money at. And so if they have to pay more money, that means you have to pay more money, for all intents and purposes. And so when that rate goes up, it changes the cost of money throughout the world, for lack of a better phrase. And every country has its central bank. Japan, the Eurozone has their bank. And that's, again, getting a little further out there. But the Fed funds rate determines that number. So that trickles down. The 10-year Treasury plays into, again, the appetite of the secondary market, government loans backing, the GSEs backing, mortgage bonds and their prices, and correspondent lending also being investors, right? That all trickles down to the marketplace and competition. And then you have the buyers and sellers all meeting, and then the desire for profit all meeting, with different borrowers of different profiles and loan types. And then that trickles down to a rate. And so that marketplace is how your rate appears. So, and again, anything has a reason why it's the price it is, similar to this, but this is, again, specific to loans, and thus even more specific to finance, but a subcategory specific to mortgages. And so to wrap it all up, if somebody was to ask you and you wanted to sound smart, or at least informed, but also be accurate, and say, I wonder what makes interest rates what they are, or influences interest rates, you could then tell them this. You say, well, it's a mixture of the health and state of the economy, investor demand in the secondary market, and then also, of course, U.S. monetary policy. And side note, monetary policy is not to be confused with fiscal policy, which is, the budget of the government. But monetary policy is, what is the Federal Reserve doing? The big bank of the United States, the central bank. And then we're just adding, little asterisks combined with lender competition and profit margins. And as you also know, the marketplace. So again, you want to just kind of sum everything up: health and state of the economy, investor demand, secondary market, and U.S. monetary policy in the marketplace. So hopefully that was a little educational. I'm trying to keep it fairly simple. If you want to get into the nuts and bolts of it, we can definitely do that. And also, there's a lot of good information you can read if you care to do that. So hopefully this has been educational for you and you've learned something and at least gained a little bit of perspective and provided a little perspective for you if you didn't already kind of understand this part. So again, what influences interest rates? What makes your rate what it is? There you have it. Take care.